Did you know that experts are forecasting a significant recovery in the multifamily real estate market? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In recent developments, the multifamily real estate market is showing promising signs of recovery. According to a report by Cody Baird, experts have observed an uptick in closed deals, which is a positive indicator for the sector. This trend is particularly significant for regions like Kitchener-Waterloo, London, and Cambridge in Ontario, where multifamily properties play a crucial role in the local economy. The recovery in the multifamily market is not just a local phenomenon. Across the border in the United States, similar patterns are emerging. Investors are increasingly focusing on multifamily properties, seeing them as stable assets in the face of economic fluctuations. This cross-border relevance underscores the interconnectedness of the commercial real estate markets in North America. As we continue to monitor these developments, it's essential to recognize the potential opportunities for investors and developers in the multifamily sector. With deals closing and market confidence growing, now might be a strategic time to explore investment options in this asset class. In a notable move by the City of Chesterfield, the City Council has approved the acquisition of the Central Park Square office building and its accompanying parking garage for a total of $17.3 million. This strategic purchase is positioned near the anticipated $3 billion redevelopment of downtown Chesterfield, indicating a significant investment in the area's commercial real estate landscape. The decision by the Chesterfield City Council reflects a growing trend among municipalities to engage directly in commercial real estate ventures, potentially to stimulate local economies and foster growth. This purchase is expected to play a pivotal role in the broader redevelopment plans, which aim to revitalize the area and attract further investment. For investors and developers, this move by Chesterfield presents a unique opportunity to participate in a burgeoning market. The city's involvement may signal increased confidence in the area's potential, paving the way for additional commercial and mixed-use developments. This development in Chesterfield can be compared to similar trends in Ontario, where cities like Kitchener-Waterloo and Cambridge are witnessing increased municipal interest in commercial real estate as a means to drive economic prosperity. Such initiatives highlight the interconnectedness and shared strategies between Canadian and American real estate markets. In a recent transaction that highlights the ongoing demand for retail properties considered to be internet-resistant, Curbline Properties has acquired Mockingbird Central. This high-profile retail center, located just blocks away from Southern Methodist University in Dallas, was sold in an off-market deal. The acquisition underscores a significant trend in the commercial real estate sector, where investors are increasingly targeting properties that offer stability against the rising tide of e-commerce. Mockingbird Central's strategic location near affluent neighborhoods and a major university makes it an attractive asset for investors. The demand for such retail centers is fueled by their ability to draw consistent foot traffic, especially from nearby residential areas and academic institutions. This trend is mirrored in other parts of the United States, where similar properties are being snapped up by eager investors. The sale of Mockingbird Central was orchestrated by the Disney Investment Group, with Curbline Properties emerging as the new owner. The firm's strategic focus on acquiring retail centers that can withstand the e-commerce boom is indicative of a broader shift in investment strategies within the retail real estate market. As more investors chase these internet-resistant assets, the competition for prime locations is expected to intensify. While this development is centered around Dallas, the implications resonate across North America, reflecting a broader trend in retail investment strategies. In Canadian cities like Kitchener-Waterloo, London, and Cambridge, similar dynamics are at play, with investors seeking out retail properties that offer resilience against online shopping trends. This cross-border relevance highlights the interconnected nature of commercial real estate markets in North America. In a significant development in the industrial real estate sector, Industrial Realty Group, Limited Liability Company, along with Provider Real Estate Partners and DW Real Estate Partners, Limited Liability Company, have announced their joint acquisition of Hilliard Commerce Center in Columbus, Ohio. The property, which spans 177,680 square feet and sits on 18.6 acres, marks a strategic investment in a market characterized by low vacancy and a lack of new supply. Peter Goffstein, Executive Vice President at Industrial Realty Group, highlighted the property's strategic location and potential for supporting community and economic growth. Situated less than 1 mile from Interstate 270 and just 20 minutes from downtown Columbus, the Hilliard Commerce Center is positioned in a prime infill industrial corridor, making it an attractive site for logistics, light manufacturing, and service-oriented tenants. Chris Salata, partner at Provider Real Estate Partners, shared plans to enhance the site with exterior upgrades and repairs to the existing structure, alongside the demolition of inefficient spaces. The site's favorable M1 zoning and ample outdoor storage and parking opportunities further add to its appeal. This acquisition aligns with broader trends in the industrial real estate market, where strategic location and redevelopment potential are key drivers of investment. In Ontario, similar strategies are being employed in areas like Kitchener-Waterloo, London, and Cambridge, where industrial properties are being targeted for their potential to boost economic activity and meet the demands of a growing industrial sector. The cross-border relevance of this acquisition is evident, as both American and Canadian markets are witnessing a surge in demand for well-positioned industrial properties. This trend underscores the interconnected nature of North American real estate markets, where strategic investments can drive substantial returns and economic growth. As we look to the future of commercial real estate, blockchain technology is playing a pivotal role in reshaping property liquidity. According to CoinSage, the Fidelity Ethereum Fund, known as FETH, has been instrumental in driving blockchain adoption, indirectly boosting real estate tokenization by validating decentralized infrastructure. Platforms like Propi and Mata Capital are at the forefront of this transformation, tokenizing commercial properties to enable fractional ownership and 24/7 trading through Ethereum-based smart contracts. This innovation is unlocking liquidity in a market traditionally known for its high barriers to entry and illiquidity. A prime example is the St. Regis Aspen Resort, which saw a $262 million stake tokenized, demonstrating how blockchain can facilitate automated compliance, digital twins, and global accessibility. These advancements are not without their risks, such as regulatory uncertainty and market volatility, but the rewards include instant liquidity and diversified income streams, attracting forward-thinking investors. The upcoming 2025 Global Blockchain Real Estate Summit is expected to accelerate adoption, highlighting tokenization's potential to transform commercial property markets. With industry leaders discussing how blockchain can address inefficiencies like opaque pricing and slow settlement times, the event is set to be a landmark moment for the sector. While the potential for tokenized real estate is vast, investors need to consider the risks, including regulatory challenges under the Howey test in the United States and market volatility. However, the benefits of higher liquidity, diversification, and yield opportunities through tokenized income streams make this an exciting time for the industry. In conclusion, blockchain-based real estate tokenization represents a structural shift in how assets are owned and traded, moving towards a more efficient, inclusive, and liquid market. The future of commercial property lies in tokenization, and those who embrace this shift early stand to benefit significantly. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.